special guest from First Capital Asset Management. We have with me, just like last time, we have Mr. Kumaravaran, Kanagasooriar, and we also have Mr. Rahul, Samarakoon. Welcome back to the show. How's it going?
Hi, everyone.
Hi everyone.
Just to give a backstory, Mr. Kumaravaran is the Assistant Vice President and Mr. Rahul is the Senior Associate from First Capital Asset Management. And we're essentially kind of picking up from where we left off the last time. And the topic last time was investing young, right? So maybe for those who missed it the last time around, if you can kind of get into a bit of a summary on what it is like and why you should invest young.
Yeah. So, guys, what we spoke about last time was basically the idea of, let's say, if you had started a year ago and we had invested in a simple, low-risk investment option, like, let's say, we talk about the money market fund, and we compare that with if you had saved money on, let's say, 10,000 rupees every single month a year ago, what the difference in earnings would have been. And we essentially spoke that it's about 3 times more. Then we dived into simply a simple guideline. We call it the GRR. We
spoke about that. Yeah.
So we just spoke about how we can first align our financial goals and look at what is our risk essentially. And we also spoke about once we have the understanding on those two, what are we left with? What can we invest in essentially?
Right.
And then we dived into what are the investment options available in the market right now. So we spoke about some government securities that's available, some corporate debt investment options that's available, and we also specifically focused on unit trust funds. And we spoke how like the first experience an investor could have when they start investing is important. And then we spoke a bit on the money market funds because it's a more low risk investment option. And also one thing that we spoke very importantly was the connection on retiring early and how we matched it with the human capital and financial capital aspects. So that was basically the recap. For this time when we speak, we are going to maybe dive a little bit more into what we spoke about, give a little bit more context. Like last time we said, you got to understand your risk. So this time we're going to actually tell you how can you understand that, what can you do, how do you assess it for yourself. So
Right. Fantastic. So let's dive right into the first question then, Rahul. So what challenges can you kind of get into in early retirement when it comes to the local context?
Right. So Rajith, for this question, I'll actually let Mr. Kumararan handle it.
Sure, absolutely. So, yes, let's go.
Thanks. Thank you for that, Rahul.
Let's treat it as a complete open flow.
Of course. Okay, challenges. I think challenges is something which is unavoidable in our life. I think whatever we do in the life, there will be always challenges. Okay.
True.
So here, what we are talking about is something that we are trying to retire early. So that's the theme of that we are talking about. Like, we are trying to retire early. So if you are trying to do something earlier than it's supposed to be, always definitely there will be challenges that we have to manage, of course. It doesn't mean that we can't manage the challenges, but we can manage the challenges. But the thing is like how we are going to manage. And also what are the challenges that we can see when you're trying to retire early and all. So if I answer that question, I think there are 2 main challenges that I would personally would see we have to give more importance. When you are managing the challenges, then we are looking at the challenges that you have to face when you are retiring early. So first thing that actually, if you're taking about in terms of the local context, if you're talking about the Sri Lankan context more, right, in terms of retiring early and all, actually people don't know exactly when to retire. Right? So you might be keep on earning. So you might be seeing like there are people keep on savings and they are building the wealth and all. But they are still working. I think they consider their prime source of income, prime job income as a major source of income because they don't actually care. They don't actually give the value for the money that they have built so far.
Right. So is it like a lack of awareness kind of thing?
That's also true.
Right.
Like, that's one of the reasons for like people doesn't have the proper idea about how to make the decision in terms of building the financial resources in financial capital. So you remember we were talking about, like Rahul said, financial capital and the human capital, right? So we were talking about last time. So human capital, as I already said, at the beginning of your career, it's actually high than your financial capital because you don't have anything in your hand generally. Because if you're talking about an independent person, you might be getting from your family, parents, that's a different story. But if you're talking about an independent person, I think financial capital at your hand when you're starting your early career, I don't think that will be that much in your hand, right? So you start building your financial capital based on the amount that or the earnings that you get it from your human capital.
Yeah.
So there will be a point where your financial capital will be higher than the human capital. So that's how it works over the time when you approach the retirement. So what happens in general practical world is people doesn't know when the suitable time. People don't know when the suitable time for them to actually retire.
Yeah.
Because they might have built the financial assets they're supposed to have to retire peacefully, but they don't know exactly.
They don't know it, yeah.
It doesn't mean they have to quit their existing primary job that they are doing, but they can be considered as a less important or maybe less dependent on the primary income that they get it from their job.
Right.
So this is the point where they have to think, okay, am I having a sufficient financial capital for me to retire? So that's the challenge you see, because I might be having the financial capital, but I don't know exactly whether it's enough for me to retire.
Right,
Because
right.
to live your same standard of living in the future, right?
True.
So that's the one of the challenge that we also see in the local context.
Yeah.
The other major challenge I would say is increment in the cost of living, right? I think all of us have experience in the past as well in the local context.
Very
right?
true.
Yeah. I think it was like one of thing that we have experienced in my life.
Yeah,
personally, if you
for
take.
sure.
Yeah. So then we should be able to see, because if you are a person who is earning from your prime job as an income, so you should be seeing first, okay, after all the deductions, maybe the taxations and all the deductions, you get the disposable income to your hand.
Yeah.
Right? So from that, you spend first for your cost of living.
Yeah.
I mean, you have to consume, right, based on the income that you get. And you also allocate part of the income for your savings. or wealth building. So we have a problem. Okay, if the cost of living is keep on increasing, which we can also call it kind of an inflation that you're experiencing, so then how you're going to accommodate the contribution that you do it for your savings and also wealth building? So then that's the challenge for us to see
Right.
how we are going to overcome that challenge.
Yeah.
I mean, there will always be a challenge, because if your income is not increasing as much as you are thinking, you keep on increasing your consumption. Technically, the cost of living is going up, which means how you are going to accommodate your saving. Because as we discussed before, like as we were talking about this before, if you can't build your financial capital early as possible, then the retirement can also be delayed. So how we are going to overcome this problem?
Yeah.
And that is the one of the challenge every investor should be addressing, and also as a person you should be addressing. So these are the two challenges I think as an investor they should be addressing to overcome this and then to achieve that goal of retiring earlier.
Right.
Yes.
So before we get into our first break, how do we overcome this challenge?
That's right. I think
Yeah.
Rahul can answer
Yeah.
this
Right.
question.
Yeah.
So basically, in this context, so if you look at it like when we put retirement planning as the main thing that we're looking at in the future, the way you can address this is basically going through the GRR as well, right? So the last time we said you got to set your goals, you got to understand your risk and then the returns. So this time, so if we just dive a little bit more into it and we look at how do you set your financial goals, you just have to look at a few things, right?
Yeah.
First thing is you got to understand why, right? You got to understand why do you need to have financial goals.
Yeah.
Right.
Yeah.
And then you got to look at what is the timeline. So you could have short-term financial goals with like simple expenses that you might have, a medium-term thing which is like a down payment for a house or a car, and the long-term thing which is essentially retirement planning.
Yeah.
Right. So once you understand, okay, why I'm setting the goals and the timelines, then you come to a part where something we've always heard very much everywhere is setting your goals smart.
Right.
You set smart goals, so specific, measurable, achievable, relevant and time bound. You set the goals there.
Yeah.
And then once that's completed, you understand, okay, look here, I have a set of obligations that I need to meet in a particular, like a short, medium term, long tenor, and I have goals that are set out to match them. So my cash flows essentially are matched to meet those financial obligations that I'm seeing in the future, right?
Yeah.
So that when you go through those steps, at the end, you're meeting what's called your financial goals.
Yeah.
Right? That's all set out. And then you jump into risk. I think last time when we spoke about, we said you got to understand your risk. So this time when you really think about how do I look at my risk and how do I understand what is my, we call it the risk capacity and your risk attitude, right? So the simple way I put it is, risk capacity is basically looking at it, how much risk can I afford?
Yeah.
Right? Simply that. Now, when you look at it that perspective, a youngster who's maybe early 20s, that guy might have a little bit
more, yeah.
capacity. Exactly.
Absolutely, yeah.
But when you are a family guy who's managing a family,
exponentially,
it might be a little less, right? So that's basically what this risk capacity means.
Yeah.
Right. And then you look at risk attitude. The way I put that is, you just have to ask your question: how cool am I about taking this risk? What that means is simply, let's say you invest in a particular asset, which is, let's say it's high risk asset.
Yeah.
And let's say it crashes by 30% on a particular day. Now, does that not let you sleep at night?
Right.
Like, does that hurt you a lot?
Yeah.
Then that means, you know that, probably that is not something I can probably look at right now.
Yeah.
Right? So, when you understand your risk capacity and your risk attitude, which is what we spoke about, how cool are you with taking that risk?
Yeah.
You essentially have come to a point where you understand your risk.
Yeah.
Right? So, on the more technical side of things, we call it, doing a risk profiling and all that stuff. But essentially what it does is it helps you understand what is my risk.
Yeah.
Then with that, you come to a place where right now you know your financial goals, your long-term, short-term, medium-term and the long-term goals. You know your risks.
Yeah.
Now you're left with a few investment options that meets your criteria.
Right.
Right? Now it's a matter of picking that like few options that will help you navigate your investments through it.
Right. Okay.
So that's basically how you
right
overcome the challenge of
right. I see. Fascinating. Yeah. And we are back with Kumar and Rahul from First Capital Asset Management. And we were actually talking off about a very, very interesting and prevailing issue, and that coincides with my next question for you. And that is, of course, the global trade conflicts that's going on right now. And we are part of that, unfortunately. And a lot of people will perceive this to be a massive threat to the global economy, which naturally, right? How do you guys kind of perceive this matter?
Right. I think that's a hot topic.
Yes.
We have to discuss
for
today.
Sure.
Otherwise, it's not going to be fair for today's discussion. So like you said, there are few people who see this as a threat. There are few people who see it as an uncertainty.
Yeah.
There are few people who see it as a problem issue. It's going to be a global problem and an issue. And there are a set of people who look it to as an opportunity as well.
True.
So why do I say like that? Right. I think so in general. Like if you see in a transaction, in a market condition, if you see the capital market or the financial market, the transaction to be happen, there should be two parties involved.
Yeah.
Right? Let's say you can't be buying a security without a seller. You can't be selling a security without a buyer to whom you are going to sell, right?
Right.
So that has to be a mutual agreement that you're supposed to do, because that's how the transactions happen. Because if everybody is trying to sell, who is going to buy?
Yeah.
So
absolutely.
then there are a set of investors who can see it as a positively, or maybe as an opportunity. There's a set of people who can see it as a threat or like a uncertainty for them.
Right.
So likewise, if you see in the local context, like in the local and also global context, recent past, I think this was the topic in the capital market also last 2 3 weeks, right?
Yeah.
Investor sentiments are here and there, and there are different sentiments coming from the investors and all. So if someone who is looking it as a opportunity, maybe someone who is willing to take the risk. Something like that.
Yeah.
So someone who is seeing as a threat or uncertainty or a problem, he just wanted to avoid the risk, or maybe just wanted to stay out of this all of these matters.
Right.
So it's a matter of investor perception.
Right.
I can't be defining, look here, this is going to be an opportunity.
Yeah.
This is going to be a risk.
Yeah.
Or this is going to be a problem.
Because it's not set in stone,
it's
right?
Not in stone. That's it. So then different investors can see this problem or like a matter or a situation in a different perspective. So
Right.
that's how the transaction happens in the market. Because like I said, there can't be a buy without a seller. There can't be a seller without a buyer. So you should name yourself as a seller. There should be someone who is willing to buy, right?
Yeah,
so
absolutely.
There's no trade.
Yeah.
So even if you see in the recent past, like in the global market, has actually most of the market has crashed because of this information, because people are worried.
Yeah.
There are people, investors are selling the securities, and there's always people who is willing to buy.
Yeah.
There are people buying. Otherwise, it won't happen. No? So
True.
So likewise, it's a two different perspective the investors see. If all investors are in one side, I don't think the market transaction will happen. So
Right.
that's the perception that you look into. Again, it related to the risk level that you are into. Like Rahul was telling before, if you're a risk taker who just want to take this opportunity, take this matter as an opportunity, and then you go ahead and do it.
Right.
And if you see it as a problem, you just want to exit and be out from yourself from this matter, and then you just wanted to see what's going to happen. So that's how you just see the market and see, because even this happened in Sri Lanka as well, like in 2-3 years ago, because the government has, like, we had an economic crisis problems and all, the government has borrowed at a higher rates, treasury bills and treasury bonds, and there are enough investors who have invested it.
Right.
Doesn't mean that no one has invested it. So that's how the investor sentiment differs. So it's a matter of the investor sentiment and the level of risk that the investor is willing to take.
Right.
So that depends on the person. Yes.
All right, I see. All right, with that, let's get right back into the conversation. Rahul and Kumar, we were talking about, of course, the global trade conflicts, and it's about investor perception and things like that. And Rahul did mention a little while earlier about risk capacity, risk appetite, and things of that nature. So on that note, how do you kind of plan for your future growth in volatile market conditions?
All right. So, Rajith, this is actually a very interesting question. So, if you really continue with from what Kumar was talking, Kumar spoke about the current global trade conflict that we're seeing and the volatile market that has created.
True.
And then we also spoke about the economic crisis that we had a few years and how that has been a volatile condition for the market and how people navigated themselves through it. So, if you really put it down in basic form, it says, firstly, what you understand is we're talking about someone who is already invested. People have portfolios, and right now, in a volatile market condition, you're wondering to yourself, look here, I'm worried. In the meantime, my portfolio, the set of investments rather that I have, is not really performing as much as I want it to perform, right? So in that condition, what you can do is simply, to start off, you can diversify your portfolio. When you mean diversifying, it means you basically, rather than you putting all your eggs in one basket, you're spreading it across a few asset classes, right? You can maybe invest in equities, and then you have some liquid options that you can invest in, and maybe you can invest in something that has a little bit more, let's say, for example, something like gold, that is a safe haven asset, right? So that is simply what you call by having a diversification in your set of investments. Then you can go to something like, basically, then you can think about another perspective. For example, right now we're talking about retiring early, right?
Yeah.
So that essentially means that your focus, like we mentioned in the financial goals, it's a more long-term focus, right? So even though you're seeing these volatile market conditions, what you ask yourself and what you think is that, well, I'm not investing for tomorrow. Yeah. Right? I'm investing for a long term.
Long term, yeah.
Right?
True.
So these conditions could essentially, there is going to be an impact on your portfolio, but you're not going to panic with it because your focus is on the long term, right? So just connecting those two, something I saw on the Financial Times recently, from 1960 to 2024, the US markets have fallen double digits every year, but there's been a double digit drop every year, but the average growth for those years from 1960 to 2024 is 10%.
Right.
So that means you've seen volatile markets, but it has grown over time, right? So that's something that you can think of, something that just a food for thought, right?
Yeah.
And with that, the next thing I can say to manage your portfolios or in your investments during these volatile conditions is have a consistent contribution. That means, I think we mentioned that last time we met as well, whenever you have a cash flow, right, you set aside a certain amount to invest. A rule that's there in this financial, it's just a very basic rule that people talk about. It's called the 50-30-20 rule. So people say you got, from your income that you earn, you spend 50% on your needs, 30% on your wants, go on a vacation, buy something fun, for yourself. But 20% you invest. Yeah. So that's something that you can do in a volatile market condition. That 20%, just keep investing it. Whether the market's falling, whether the markets are rising, keep investing it. And then another thing you can look at is, it's a little bit more advanced, but we call it the portfolio rebalancing. But although it's a big word, what you're essentially saying is, now when you have a portfolio, sometimes let's say you have a 20% in equity, as in stocks basically, and then you have another 20% in liquid form, and then you probably have a set of classes of assets, right?
Right. Yeah.
So in a volatile market condition, depending on what we spoke, your risk appetite and risk capacity, If you're a risky investor, you might think, okay, you know what, I'll increase my allocation a bit more onto something like stocks. But
Right.
let's say you are not as risk seeking, you're risk averse. Maybe what you can do is you can create those assets in form of liquid a bit more,
Right. Okay.
right? So that's one thing. And then one other thing you can do, very simple. I think that's the most important thing that people need to understand who's investing is stay informed,
Yeah.
right?
Yeah.
When you see something happening, the first thing you got to do, there's ample of sources of news that you can get. Read on it.
Read on it. Yeah.
See the actual impact it has on your investment portfolio.
Yeah.
And then make a decision. Rather than making a decision and then trying to look on what's happening,
Yeah.
do the reverse, right?
Yeah.
So that's simply what you can do in a volatile market condition.
Right. Okay. Yeah. Yeah. Stay informed. Yeah.
Yeah,
absolutely.
absolutely.
Yeah. Fair enough. And last but not least, how can someone, with all the information that they've gathered now, how can they get started? How can First Capital help someone grow?
Right. Rajith, I think like I said last time, we are always ready to partner with
Yes.
whoever who wants to be. So
Absolutely,
we are
yeah.
ready to help them to begin their investment journey or just improve their investment journey throughout their investment period. So First Capital, I think, so we are from First Capital Asset Management.
Yeah.
So just to give a kind of an introduction to it, because we have two businesses, unit trust funds and also like wealth management that we also do. So in terms of the First Capital Group, I think we have diversified the sectors that we have actually in terms of business units.
Right.
So we have a primary dealer arm where we do the government securities, and then we have corporate finance and advisory and
Yeah.
equity. So there are different units that we operate under the First Capital.
Right.
So asset management, if you take, so we were talking about this, how to retire early. So if you are retiring, what are the things that you should be looking into? What are the challenges and all?
Yeah.
So if you're really serious about it, so how you're going to get started with it and all. So we also provide that service under the asset management, private wealth management. We do provide the advice and also guidance to the client, and also we take the money on behalf of the client and manage it on behalf of the client according to the client's investment objectives. So that's what I said, because you might have different objectives. So that's what the discussion that we were having as well. So as a First Capital, we are ready to give all the information that we can provide to the client to make a smart or like a correct investment decision that the client wants to make in line with the client's investment objective. So just to reach out, so you can call us anytime, like we said last time, and also you can visit our website where all the informations are available there, www.firstcapital.lk.
Yeah.
So there you can visit, and then you can see the online platform where you can access there, and for the information that investment that you have made with the First Capital, you can actually check. So you can monitor it and throughout the period and all. So whatever the investments related advices in terms of starting an investment journey or like growing the investment further, we are also always ready to provide that support or partner with anyone who wants to actually grow their investments. Yeah.
Absolutely.
Yeah.
Fantastic. So there you go. Now that you have all that information, get started with First Capital today, and don't worry, you are in good hands. All right.
Yeah.
Thank you so much, Rahul, and thank you so much, Kumar, for coming on the show and for having this conversation with me. Can't wait to have you guys back. And I'm excited for the next discussion that we're going to have.